Good morning, and welcome to the 41st Annual Opportunity Finance Network Conference. As Aisha mentioned, my name is Dan Letendre, and I manage the CDFI activities at Bank of America. And we are the lead sponsor for this year's conference, as we have been for the past 18 years. We understand how important OFN is to the CDFI industry, and we understand how important the CDFI industry is to a better functioning financial system. Now, if this is your first time at an OFN conference, welcome, and congratulations, you've chosen well. Get ready for 3 days packed full of events. Back-to-back-to-back meetings with investors and funders and CDFIs and advocates that will feel a lot like 72 hours of speed dating. Get ready for great panels and panelists who will challenge your thinking and may shift your perspective. And all of that surrounded by 2,100 like-minded individuals, all pursuing a common mission. Welcome. If you are a returnee from past OFN conferences, particularly if you were at Los Angeles, welcome back. And I think we can agree this has been one challenging year. I mean, when I welcomed you from the stage in Los Angeles exactly 1 year ago today, we were all filled with optimism. And for those of you who know me, you know I'm not an optimistic kind of guy. But we were in the midst of unprecedented growth in this field. Universal support from the private sector, foundations, and the public sector, city, state, and federal government. In the intervening 12 months, a lot has changed. So much is in flux. Government support has waned. Philanthropic contributions to CDFIs have decreased. Some private sector investors have become hesitant, worried about CDFI certification or the continuity of programs such as the Bond Guarantee Program and New Markets Tax Credit. Indeed, while this year's conference theme is Opportunity Next, I've heard from a lot of CDFIs that deal day in and day out with challenges and changes that are often wondering, what's next? Really, what's next? But we've been through dramatic change before in our industry and significant challenges. I've been investing in CDFIs now for over 3 decades. This is my 29th annual Opportunity Finance Network Conference. When I first started, there was not large amounts of governmental support in capital. It was the nuns, the religious orders, the Dominicans, the Sisters of Mercy, courageous women who invested their retirement savings in organizations that today are called CDFIs to support the work that you are continuing to do. Then came the philanthropic support, the foundations, Ford Foundation, MacArthur Foundation, F.B. Herron Kellogg, and others, who provided dramatic sources of funds to develop and move and change this from a movement to a sector to an industry, and set CDFIs up to be ready to accept large amounts of private sector capital from banks and other CRA-motivated investors that leveraged your balance sheets and increased manyfold the work that you continue to do. Indeed, for most of my time in the CDFI industry, outside of the CDFI fund, the federal government was not a significant supporter of CDFIs, at least not in scale. But once they started, oh my, what scale we saw. In the last 10 years, from 2015 to 2024, we saw unprecedented amounts of both capital and subsidy from nearly every federal government agency: Treasury, SBA, Education, HUD, EPA, USDA, VA, and on and on. Nearly every government agency discovered that they could provide grants, subsidy, to CDFIs that would leverage that with private sector capital many times over and finance projects, programs, initiatives that the government wanted to see happen, that society wanted to see happen, but that could not happen with only private capital without the subsidy. Indeed, we came to anticipate, expect a new thematic subsidy program almost every year. You remember the programs: Fresh Foods Initiative, Capital Magnet Awards, Native and Rural Awards, Health, Disability, ECP, PPP, Community Advantage, and on and on. This approach, a new government subsidy every year for ever increasing amounts into the billions, became the dominant business model for much of the CDFI industry. It became the dominant investment thesis for much of the private sector capital that came into this industry. But I think we must acknowledge that that business model no longer exists and cannot be counted on, at least not today. And that investment thesis can no longer be counted on, at least not today. Now, I'm not saying that there isn't a CDFI business model. Of course there is. There are many. And I'm not saying that there isn't an investment thesis for deploying capital into CDFIs. Of course there is. But we've been here. That approach that we must now rely on looks very different than the one I've relied on and anticipated and studied for most of the 10 years. As I mentioned, this reliance on federal government subsidy has actually been an anomaly in the broad history of the CDFI industry, has not been relied on over the course of the entire industry. And at Bank of America, we understand that. We understand this historical context, which is why at Bank of America we will step into this moment in investing, not step back or withdraw from our investing in CDFIs. I want every CDFI in this room to hear this, and I want every investor in CDFIs with capital invested alongside of us to understand this. At Bank of America, as we go forward to grow, not shrink our activities with CDFIs, we will be guided by three principles, three lessons we have learned over the past 3 decades. 1, investing in CDFIs is good business. It is prudent business. We recently did an analysis of the past 25 years of lending to CDFIs at Bank of America. This is a period that stretches over recessions and great recessions and pandemics and every form of economic stress that you can imagine. The total credit losses in that entire portfolio over that entire period of time was less than 6 basis points, 0.06%. And that is not a portfolio of short-term loans and 1-year, 2-year loans that are collateralized with real estate or marketable securities or other forms of collateral? No. As those of you who we invest in knows, the typical transaction between Bank of America and CDFIs is for 7 years or longer. And the typical transaction for Bank of America investing in CDFIs is unsecured, relying on nothing but the unconditional promise of the CDFI to pay when due. 25 years, long-term loans, unsecured, less than 6 basis points of losses. Not bad, eh? I mean, even my credit risk officer, who's sitting in the front row over here at the table, has a big smile on his face. And he doesn't smile at very much. But he smiles at this. My CDFI team, which I have been honored and privileged to work with for many years, operates in Bank of America as a profit center. Not a cost, not an expense, not a regulatory requirement, a profit center. Now, I will acknowledge we are not the most profitable business in all of Bank of America. We don't try to be. But we do demonstrate year in, year out, every year, every decade, that we perform at a break-even or better basis to demonstrate, to prove that investing in CDFIs can be done sustainably, financially sustainably. Principle 2. CDFIs make our bank better. You do. You enable us to serve our communities better. You enable us to serve our clients better by referring to you or you referring to us. You enable us to reach new prospects and new future clients that we would not otherwise be able to reach but for your preparation and help. You make us better. But don't rely on my word. I mean, I've spent my whole adult life pursuing this mission and supporting this field. Of course, I'm going to say that CDFIs make our bank better. But go back and listen to the Bank of America CEO, Brian Moynihan, who from this stage at the very last OFN Washington, D.C. conference, went on for 30 minutes about the partnership between Bank of America and CDFIs and why that was important, and how CDFIs are a critical component of Bank of America's growth strategy, our responsible growth strategy. If you don't believe me, go back, Google the video, and listen. And number 3, we believe, we know, that CDFIs have become a permanent factor, a permanent place in our financial system because CDFIs are needed. Our communities need CDFIs and the work that you do. Banks need CDFIs for your partnership and the further reach that you enable. Philanthropic foundations need CDFIs to bring the leverage to scale manyfold the impact of each and every donation they give. This country, our country, needs CDFIs and the work that you do. So when you go forward throughout the year and you deal with new challenges and changes, and you hear yourself wondering, what's next? Know that CDFIs and the work that you must continue to do will be part of what's next. Uncertainty? Of course, uncertainty will be next. Your business models will evolve. Our underwriting to CDFIs will evolve. But as your investor, an investor to more than 250 CDFIs, providing more than $2 billion in capital to CDFIs across the country, know that we will build that with you together. Uncertainty, sure, but with uncertainty always comes opportunity. So yes, opportunity is what's next, because you and we will be the ones to determine what's next. Thank you for your time, and let's make this conference the best one yet. Thank you.